Well, thank you for joining us today. My name is Marc Montini, and my company is the Montini and Company Tax Advisory Group. And for the next 10 minutes or so, we're going to talk about why it's so important to get all of the assets that you have consolidated into one easy and organized position. Real brief about us, we are both a tax and financial planning firm. We're a one-stop shop for your planning needs. Tax and retirement planning go hand in hand. You can't do one without the other. I am a licensed fiduciary and an independent financial advisor. I've been in financial services now for about 28 years. And as a firm, we really specialize in tax reduction strategies. And we're going to achieve that by utilizing our proprietary retirement income planning system. And within that system, we have the income plan, so you can see where your money is coming from, that it is sustainable and is being taken in the most tax efficient manner possible. And in that system, we have a corresponding tax modeling system. We do manage assets. That's part of the financial planning side of things. And we do tax returns. Our taxes start at 175 and they go up very modestly from there, depending on the complexity of your return. Now, getting your assets consolidated, is this what your retirement looks like? You have money over here, a little money over there, a little money here, a little money there. If so, we want to get all that consolidated in, and here's why. Okay, we're going to talk about all this in greater detail, but number one, you're less diversified than you think. We need to help better manage the fees that you're paying. We want to look and pay attention to wealth transfer for both your spouse and your children. And then when it comes to having to take your required distributions, we want to be able to simplify that process. But then we're going to close with that having multiple accounts can be advantageous if it's done right. Now, you are going to be less diversified than you think because it's very, very common for the big box brokerage companies and the big banks to use very similar canned allocations. Okay, and those allocations can be in mutual funds and in ETFs, and it's typically a 60-40 allocation. It could get a little more conservative as you get older, or a little more aggressive if you're younger. But generally, we're going to have an allocation somewhere in that 60-40 range. Well, let's say ABC Brokerage Company, okay, has your 60% stock diversified amongst 3 different mutual funds, okay? And XYZ Brokerage Company also has your stocks diversified amongst 3 or 4 different mutual funds. Well, generally, those mutual funds are going to be in the same class. They're going to be large cap growth, large cap value, maybe mid cap, maybe small cap. Okay, but when you actually break down and look at the holdings of these 2 different mutual funds, within the holdings, within those mutual funds, you're probably going to have some of the exact same stocks contained in there, right? Companies like Alphabet, companies like Apple, companies like Facebook, companies like Johnson & Johnson, companies like Ford. I mean, all these are common companies that are going to be held within these mutual funds. And if an ABC brokerage company has their mutual funds with those stocks in there, and XYZ has the exact same stocks within their mutual funds, then you're less diversified than you think. We prefer a tactical approach to money management. We don't necessarily believe in buy and hold. And here's why. On this chart, you're going to see at the top of the chart, you're going to see the top performing asset class for that particular year. And at the bottom of the chart is the worst performing asset class of the year. Well, let's just pay attention to the purple box down here. This is emerging markets. So 2008, it's the worst. 2009, it's the best. 2010, it does okay. 2011, it's the worst. 2012, it's one of the best. Okay, we want to be tactical. We want to have action in how your assets are allocated. We want to be proactive to what's going on in the economy. And if we deem that large cap growth is the place to be, then that's where we're going to be. But as the economic cycle shifts, then maybe we go into real estate or we go into other asset classes that may perform better based on what the economy dictates that we should be invested in. Now, paying attention to the different fees that you're going to have amongst the different brokerage companies. There are definitely some large big box brokerage companies that do offer less fees than others. right? But what are you getting for those less fees? Um, how apparent are the fees that you're paying? Okay, I just brought on board a new client yesterday, and as I was going through her account statements, I could not find what they were charging her to hold her money, and I know they were. I could only see what the fees were within the mutual funds that she was invested in. So speaking of mutual funds and versus ETFs, okay, a mutual fund is simply a conglomeration of assets with a mutual fund manager. That mutual fund manager's got to get paid. That's called the expense ratio. Okay. Well, you can buy the exact same corresponding ETF of that mutual fund, meaning the holdings are the same, except they're not being managed internally. And because there is no mutual fund manager inside of the ETF, you're going to find that your fees are going to be significantly less. Are there trading fees? Okay, a lot of these big companies have gone to a zero commission platform, meaning you're free to trade all day long and not incur any additional costs. But there are still some brokerage companies that will charge a transaction cost. So we want to pay attention to that. And also, have all of the fees been firmly disclosed? One of the things about being a licensed fiduciary is that we do believe in transparency. And when we put a plan together, we always finish with, here's what your annual fees are going to be. And it's in writing, and they can see it, and we're transparent. Now, when it comes to wealth transfer, at some point, we do have to address our own mortality. Okay. And does your spouse know where all these accounts are? Okay. Sometimes spouses want to be kept in the dark. They don't want to know what's going on. They don't want to follow what's going on with the stock market. They don't want to see any losses. But it is best that they at least have some type of higher level knowledge of where the assets are. Do you have a plan if something's going to happen to you? Okay. And do your children know what assets you may have and where those accounts are at? Because if something suddenly happens, okay, it's not going to be easy to track down everything that you have unless it's in one simple consolidated area. I do frequently reach out to the children of my clients, if for nothing more, to at least make an introduction and let them know that if something were to happen to their parents, that I'm definitely a contact that they need to reach out to. Part of getting everything organized and into a consolidated position is going into our retirement income plan. Okay. And this is what our income plan looks like. And this is the income planning portion at the top. And below here, this blue level, you can't see, but there's the corresponding tax modeling system below this blue line down here. And you can see when we look at the assets, okay, we can know where these accounts are. Now, here in this example, you'll see that I have diversified not only by asset, but I have diversified by portfolio management. So it can be advantageous to have multiple portfolio managers involved if it's done the right way. And we're going to talk about that next. Now, having everything consolidated into one place is very makes income planning much easier. Okay, if we know that we can take income from one source versus trying to take it from 4 or 5 or 6 different sources, that's going to ease your retirement. It gives us better knowledge of what your tax liability is going to be. Okay, having things consolidated will also open our eyes to, does it make sense to convert from your traditional IRA to a Roth? Now, this is a really important part of what we do. A Roth IRA can be a tremendous retirement planning tool. And if you want to know more about a Roth, I do have a 12-minute mini webinar dedicated exclusively to the benefits of having a Roth IRA and converting your traditional IRA to the Roth. So you can find that on my main website, montinico.com/webinars. Not only that, you can find little mini webinars on rolling your 401k to an IRA, what the new required minimum distribution rules are like, what really goes into retirement. How do you retire? I've got a little mini webinar on that you may enjoy. So please enjoy the content. Now, some of the benefits of having multiple accounts. First off, work with a licensed fiduciary like myself and a financial planner. Okay, somebody that has access to multiple portfolio management. What that allows us to do it adds a new layer of diversification in that not only are we going to be diversifying by asset, but we're also going to be diversifying by portfolio management. By using different portfolio managers, they all bring different philosophies as to how we mitigate risk, how we're going to see growth, how we're going to generate retirement income. And so now if we're going to have multiple accounts, we're going to do it this way and do it right. What I have found is that by utilizing different portfolio managers is that these guys don't all kill it all the time. Okay, this year, this one did great. This one did okay. Now, next year, economic cycle shifts. Now, this one does great and this one does okay. And what that's going to do for us is that's going to be able to give us a more stable and consistent return over time, which is really ultimately what we're after in retirement. Now, how do we do this consolidation? Okay, again, don't do this on your own. Okay, work with a fiduciary like myself and a financial planner. What I'm going to do is I'm going to first organize your accounts by their tax status. I'm going to put all your IRAs here and all your Roth IRA here and all your individual accounts here. Okay. But we have to exercise caution because especially regarding your non-qualified and your individual accounts. Okay. If we sell those assets at an inopportune time, we could generate long-term or short-term capital gain taxes. So my job is to look at the statements and look at what your cost basis is and what the account value is now. I will say that it can be advantageous to work with somebody that has a clear understanding of tax, because I may see opportunities where we can do some tax harvesting where, yeah, you may have some capital gains from this particular asset, but we can offset some of those gains from the losses you have on this particular asset. So we're going to look at all that very, very closely. Again, please work with somebody like myself. Don't try to do it on your own. Let me help. Now, with that, that's the end. And I would encourage you very much to continue your education. Okay, on this page, if you fill in the form, give me your information, you will have access to my comprehensive 40-minute webinar, immediate access, and you can watch it whenever you'd like. We're going to talk about Social Security, income planning, taxes, assets management, all in greater depth than what I have done here today. You can also find more of these little mini webinars on my website. That's montinico.com/webinars. You can find it right in the menu bar on my main page. Also, go to montinico.com/retirement-questions. And here, I think you'll enjoy. I had some of my favorite clients email me, and I asked them, what was your biggest concerns before you retired and your biggest concerns after you retired? And I just answer them as openly and as honestly as I can. And I think you'll get a lot out of that. Lastly, if you enjoyed this, please share this with your friends and family. Retirement's a lot more fun when you can retire with friends. Thank you. And I look forward to speaking with you in the future.